And we're live here on the Independent Investor channel. My name is Ryan. Welcome to all the would-be subscribers and the existing subscribers to the message here. Glad to be with you on a Friday evening, late February 2025. Volatile day in the markets. Love to just sit back, reflect, and talk about, the day as it unfolded. Really no surprise to me. What does it mean for the rest of the year? What does it mean for your portfolio? Doesn't mean, as the title suggests, that your money will evaporate away. You gotta tune in to find out my perspective about what's going on in the market, my opinion, and that's all that this ever is opinion and discussion about what this could potentially mean. If you were a momentum follower, you'd be all kinds of confused as to what to do. I tend to try to parse through the noise, and I'm not here to tell you what to do. What I am here to do is share my journey as it reflects on my independent approach to wealth building. And if I can convey that, we can move away from people thinking that they need to be influenced one way or the other. That's a lot less important than getting your psychology about markets correct. It'd be fun if I could come onto social media and when everybody was momentum praising the market, just to come on and, feed into that frenzy and feed into that momentum. That's what people want. People want to hear what they want to hear. I tend to try to deliver what people should be hearing. And that is an independent approach initiated, and I announced it in January. I thought 2025 was probably going to be a year a lot less indicative of the previous two. That was my call. I reserve the right to be wrong in the stock market. Successful investors are only right 1/3 of the time. If you can be a 300 hitter in investing, you're doing just fine. Look at the statistics. You don't have to win every game. You don't have to succeed 100% of the time. You don't need to bat 1,000. Okay. What you need to do is have a head about you and understand that if you're working with $1,000 or $5,000 or $10,000, I'd love to go back. I just love investing so much, and I love to convey the power of wealth building. I just think that it needs to be kept in a box. You have to have some perspective about this. Don't get arrogant. I'm going to tell you guys, in the first couple of minutes of my live stream, I've been doing this for close to 10 years on YouTube. I just enjoy the hell out of the project. You guys have lived and evolved with me. I started doing this project. I had 62,000 in the portfolio. We'll do a robust portfolio review. I've got some really cool stuff to uncover for you guys. The 50 stock dividend portfolio. I'm going to declare the top 25 holdings to you guys in the dollar amounts. I'm going to run those as tickers during the live stream so you can kind of look at what I do. There's no right or wrong way of doing investing. This is just my way, and it is independent in my thought. I've evolved my approach to stock market investing over many, many years to really come down to a few specific categories, that of which I can share with you, and I do convey week over week. Scrutinize the program, no doubt about it. I'm tough-skinned. It's okay, but there needs to be more people like me sharing their story about how to make sense of this malarkey. Because if you looked at the market today, Dow down 750, S&P 500 off as well, a couple points on both the major averages, Dow and S&P. NASDAQ obviously took it on the chin as well, with technology selling off pretty heavy today. If you're a would-be investor and you're looking at this thing, you can scratch in your head and you say, Ryan, Jesus, how do you make sense of this stuff? Very, very simple. Don't get emotional about investing. Hate to bring up the old cliche, but I come on many, many times in the live stream when things are all hunky-dory and it's like a celebration in here. I expect today to be like a death morgue because people have a harder time focusing on financial markets when they're like this, as if they're a place that cannot be touched or should not be touched or should not be taken advantage of. My friends, I was buying. Those are the little nuggets I give you. I was buying and recalibrating the dividend portfolio today, to really hone in on the strategic focus of the dividend portfolio. We're achieving a 4% yield over that portfolio, 77,000 of total holdings just in the dividend portfolio alone, which means about $3,112, I think, to be exact. So just over $3,000 of dividend yield per year in that, what is a segment of my overall portfolio structure. Okay. I've talked about the structure for many, many years now on YouTube. And for the people that truly understand it, they would have started with the self-directed Roth IRA account. Self-directed, the piece that I really, really like to focus in on. I think even Robinhood is offering Roth IRAs now. You can get a Roth, account opened up by any of the major brokers. The Roth is very, very important to understand, but the more important aspect of what I convey through the channel is the education to empower investors to understand that they can house the appropriate assets within that Roth IRA, and they can do so over time. That really is the pillar. It's the starting of my program. It's the bedrock, the cornerstone, the top of the pyramid, however you want to think about it. And the question becomes in the deliberation of what goes into the Roth to make you a successful investor, whether or not you're starting at $500 or 1,000 or 5,000 or 10, working your way toward that first 10,000. The Roth really is the best way to keep that tax acknowledgement and the cost, the fee of ownership to a minimum, if not completely negated when you first start. The Roth IRA is something that you'll start. It'll be with you the rest of your life. And what a powerful aspect. I like to remind everybody that they get to catch me live, unscripted and unabated without commercial interruption. And you're lucky if you're catching this message. There'll be about 750 people who catch my live stream. I am a corner of YouTube, and I am an unappreciated one at that. The funny thing about it is I don't give a shit. I am exactly what I say. I am working toward that self-made millionaire status. We'll get there eventually. There's no doubt in my mind. And there shouldn't be any doubt in your mind at all whether or not you're working with that 500. And don't be intimidated by coming into the channel. If you're just starting out or you want an introduction to investing, I've been through there. I've walked the walk. I have no problem recollecting what it was like along the path of investing, what some of the pit stops and perils had in store for me as I was, you know, navigating through trying to understand what it meant to be an investor, what I was trying to do. Every year that goes by, I evolve in my approach and my philosophy and discipline and how to really use strategic allocation to hedge my risk profile and really align what it is that I'm trying to do. And the only way that you can do that is to be honest with yourself in trying to identify what it is that makes sense for you and leave all the noise over here. Separate those two elements. Okay. Johnson and Johnson, for example, is not going anywhere. It's a 110-year company. All right. That's a cornerstone of any portfolio that we could look at it as an example of what could be housed in the buckets that we speak about. But if you don't understand the psychology over the accounts, then what is the point in talking about a J&J and a Procter and Gamble, you know, and an Apple computers? It doesn't make any sense to talk about those tools if we don't understand the attributes of understanding the different buckets of allocation. And that's why I start with the most simple, and that is the Roth IRA. It's the greatest gift I can give you. Most people understand that it does exist, but most people don't really think about it the way that I convey. It's one of those things that'll be with you the rest of your life. How many things will be with you for your entire life? Your wife, right? Your life, your Roth IRA, your cars? I don't think so. Your job? Not even your job. You do 20, 30 years, right? Your clothing, you know, think about those things. We're conveying the goods on the channel. And if you're a new, uh, patron to the message and you're trying to understand those real fundamental nuggets, I typically try to highlight those for those new investors who may be making their way in and they don't have a Roth. And then they can understand, how important that is to establish. And then we can talk about the makeup of that account, because a naked account with no funding is just that. But it is absolutely a start and a step in the right direction for you, in understanding that you've probably established one of the most important buckets that you could ever start, and that will be with you the rest of your life. Couple of themes that I want to share with you guys. I mentioned the dividend portfolio. I will share that after the quick intermission here. But I did start a growth portfolio. I've had it before. I had it with M1 Finance. I have started it again. And it seems to make a lot more sense to have my growth stocks, Palantir, CrowdStrike, Adobe Systems. I did throw Apple and Microsoft and Google, with your value plays in there, with NVIDIA, CRM, Salesforce, which is a value play as well. But companies that I just felt that were more appropriate, it housed in its own portfolio, so I could track the high beta in the portfolio. Beta meaning the swings could potentially go volatile high, volatile low, and then control that beta with the amount of money that I have. You'll see I've got an $8,400 bill in there. And so I don't mind going back, like I said, and starting a small account like that with a strategic niche that's carved out for myself to meet what I feel like is a fundamental pillar underneath the Roth IRA. Those fundamental pillars being savings, right? Dividend growth, very, very powerful. We'll talk about that, and I'll share that after the break. The growth strategy, and then finally the passive strategy, which is something that's also very, very equally as powerful, but one that you guys know and that I have conveyed over the channel, that I have taken some of that risk off of the table, because I felt like passive ETF products specifically that track the S&P 500 had probably run a little bit too far, too fast. Um, I reserve the right to be right or wrong, but my thinking of it is just very, very simple. 2, 3 years ago, when the market was absolutely horrendous, and it was indicative of what the market did today, and I was coming on and I was talking about being pretty excited about investing in those down markets and into the teeth of what was absolutely horrendous markets. Very, very difficult for people to do. Brave on my part to come on and convey those challenges in the market, of really looking at that from an opportunistic or a contrarian type of perspective, and putting that capital to play, when not a lot of people are looking at it that way. The news media, will come on and they'll convey that hell is going in a handbasket, and that's kind of the nature of my title tonight, is not to mislead you, but to represent what I think some of the pulse of the market is. They're going to play on your emotions. If you're going to allow your emotions to be played on, my friends, they will be played on. Me, I typically try to give you what it is I feel like they are trying to convey and what is the real speak. Okay. We're coming off of 2 years straight of 20% S&P gains. Absolutely fantastic. Okay. One day in the market, even as big as the downtrend was today, will not make a market. We could be up 750 on Monday. Who am I to say? Okay. I just think that 2025 is going to carry with it a lot more volatility than we are used to. Okay. And a lot of people will start blaming whether or not it's true or not true. And Trump did this and the Trump did the tariffs and the Elon is this and that. And then the real estate is off 5%. Boom. We've talked ourselves into a 10% correction like that. I just want to remind you, and I don't mean to joke about this, but what people lose track of, and it's unfortunate that they do, and it's something that I talk about all the time, and I'm fairly unpopular for it, is I will absolutely stay lockstep with you guys in recognizing when we are up in financial markets. It's why we do what we do. We would not do financial markets if in during certain occasions we looked at our portfolio and said, wow, that investment paid off, or that strategy paid off, or that's a good thing right there. Okay. We wouldn't do it. I wouldn't do it. It's a waste of time, right? I just throw this thing into the trash and go on about my life doing all the multitude of things that I enjoy doing. But the fact of the matter is the stock market can be very, very lucrative. Okay. But it is extremely irresponsible to talk in the way that I have felt like the stock market pundits want you to believe, is that the stock market never goes down. And I'm here to give you some staunch reality, okay? And I think people get lulled to sleep to the upside when the stock market doles out returns of 20% year over year, and it's fun and it's easy, and no matter what you have invested, you've made money and it's easy, and you look at it and say, that's nice. Thank you, sir. May I have another? I want another year of 20%, and I want another year of 20% and another year. My job is to come on and remind you that it's not going to be 20% every single year. And as 2025, with the volatility that we know we're going to have, because the Trump and the Elon and the tariffs and the Doge and all the blah, 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 is going to talk ourselves into that correction. Okay. I believe that all of that is noise. I believe that the undercurrent and tone of the market that's really going to systematically link up and provide that systemic shock and downtrend is going to be real estate. Nobody's talking about it. Pundit after pundit after pundit will come on to CNBC and talk about, well, earnings are good, earnings are good, earnings are good, earnings have been good, and they're going to continue to improve. Blah, 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 blah. Let me tell you, there's been some companies that have reported some phenomenal numbers, right? And the hint that there is a crack in consumer sentiment, Walmart, okay, and the stock goes down. All right. So don't think for a second that the trajectory is just going to stay on an upward trajectory forever. Okay. We look at it at a long enough time horizon. And yes, we want a slightly appreciating and uptrending graph to the right or to your left or to your right. You understand what I'm talking about, right? We want that over time, but don't think for a second that you're not going to have your 10, 20, and even your 30 and 40% downtrends if the systemic shock is perceived to be good enough to render those types of corrections in the market, i.e., COVID, okay, i.e., the financial crisis of 2009, 2010, real estate related. Oh my goodness, you're kidding me. You mean we can have a real estate market affect the stock market? Absolutely. And that's what people are not understanding about 2025. Outside of all the noise and all the rhetoric about us buying Gaza and about us, making Gaza full of hotels and businesses. Okay. I can appreciate it, but I thought, you know what? The first time that the president mentioned that the stock market's up 10% since being elected, I thought, oh my goodness, there it is right there. An inability to understand that the stock market, as solid as it is in the US, And as solid as our footing is as an economy, in my total overall opinion, okay, that's irrespective of the debt that we have, okay, things are good, but things can absolutely introduce volatility. And my friends, we haven't had a lot of volatility for quite some time. I don't mean to scare you on this thing. I'll show you some of the attributes that I deploy to win in up markets and down markets. So stay tuned, guys. We'll be back with you in just a moment. Super cool stuff, man. It's really an honor for me to do this. And I do want to welcome everybody. It's just my job, guys, to talk about both the positive and the negative. Look, if you want to go through life and be neutral, no problem. Go be neutral. All right. The stock market requires you to have some level of risk appetite. Okay. It requires you to be realistic. Okay. I warn against people putting their head in the sand and ignoring both the positives and the negatives about the stock market investing game. Okay. Um, Over allocating, looking at a company like a Palantir and saying, you know what, it's a great company. I want to just put everything I have into Palantir. Okay. It can make sense for people to take a strategic shot at a Palantir, right? When you have a lot of the other bases covered. And it's super, super important for people to really understand that. So I'm always trying to play on both sides of the coin and let you guys know that there's more than just one or a couple perspectives in this deal. All right. The very cool stuff. So I want to jump in here, guys, and share some of the work that's been done. We'll go over the portfolios real quick. Taxable account took a reduction here with some cash that I had idle on the side. Those fundings went to the growth strategy, which is a new bucket. I will share that with you shortly. But Aduro Clean Technologies is hanging in there. It's a wonderful segue to let you guys know that tomorrow I will be filming and probably have released in the early afternoon tomorrow my panel discussion on Aduro Clean Technologies. It is my bullish conviction pick. It is my hyper growth pick for 2025 and 2026 and 2027. So I'm covering you for 3 years of basis going forward. I will have Yazan, I will have Mariusz, and I will have Penny from all corners of the world, West Coast, Midwest, myself on the East Coast, as well as Yazan, who's going to be tuning in with a special from around the world. We're just absolutely ecstatic. I'm a student of the game, my friends. It's a pleasure for me to host a live stream, but you guys need to understand the value is like salivatingly rich. I mean, you've got Penny who's knocking down interviews with the CEO on a pretty consistent basis. That's fantastic. I sit like a kid in a candy store because that amount of transparency for a company that's, yeah, it's small, 150 million, and I get it. That's a benefit for us as share owners to be made privy to those interviews, but he doesn't have to do that. He doesn't have to, and with some pretty good regularity, making himself available through the interviews with Penny, and I just appreciate the hell out of it. She will be with me as well. Tomorrow, we'll throw down on the content at noon, and I should have it live tomorrow early afternoon as soon as I can get the thing cut up, diced up, and online. Okay, so stay tuned for that. Catch it. I don't know what else to tell you. Yazan is really one of my favorite people that I have met so far. I've known him now a couple of years, and his insight is really, really second to none. And I identify certain pieces of his application that is just right on par with the high bar that I require the people that I associate in my circles to have. And I don't mean to judge, but I expect that people speak along a very, very temperate level. And this man does that. Okay. He's very, very diplomatic about his application, and he's very, very intelligent. And coupled, with that very, very reasonable demeanor, he's really a treat to listen to. And I'm glad to have him in my circle. And it's going to be fun to have Mariusz, who owns 1% of the company. You're talking about a massive representation of share base in Enduro Clean Technology. And it'll be fun to bring together the panel tomorrow. We haven't done it in a while. We were getting a little heat on Stock Twits to make sure that we were doing our fair share. I'm in patience mode personally on the i2, having next generation process probably, a quarter or two away. But nonetheless, we do owe it to the investor core and the group, and we're going to throw down. So stay tuned for that. Okay, guys. So 63,928 in the taxable. Roth 1, just over 150,000. You'll see some additions in these portfolios, and I'd like you to take note of those additions. This is in the Roth. So you can take some of my pedigree and take the fairy dust, and you can sprinkle that fairy dust on your own portfolio. See how I apply this. VOO S&P 500 ETF sold off to the tune of, a fairly light position in S&P Holdings now. I had over 110 shares. I have reduced that shareholding, and I have put cornerstones in there. Pretty nice position in Enduro. But BlackRock, JP Morgan, Caterpillar, Travelers, IBM, Costco, and Visa, some large cornerstones in there, some pretty big positions. I've liquidated the smaller positions in the dividend portfolio and rolled these into the tax protection in the Roth. Now, I do hold a significant amount still of cash, with the idea that eventually, when I feel like we get this sell-off in the market, then I can strategically step back into the market, not with the intention of timing the market, but making sure that we're giving ourselves an opportunity to win in both ups and down markets. Okay. Roth 2, this is mine. You'll see there that I have just started the build back. Cummins and Goldman Sachs being the two cornerstones in this portfolio, they just seem to fit really, really well in the Roth IRA. This was after a lot of deliberation, pulling them out of the dividend portfolio, and allowing these assets to be housed in the Roth IRA. You want to make sure that these assets, before they go into the Roth, are companies that you can recognize, that you can relate with, and that you could see investing in for a long time. And if you want the validation, don't hear it from me. Look at the 5-year rate of return on these. Don't look at a 1 year. Don't look at a 6 month. Don't look at a 1 year, a 5 day, or which means jack dick nothing. Okay. You want to look at a 5-year rate of return on these, and you're going to find 5-year rate of return starting to get healthy. If you start to kick it up into the 10-year rates of return, it starts to get a little bit insane. In other words, I will convey to you the greatest secret on the i2. Investing is fairly lucrative if you're willing to go ultra long. Okay. There are books written on this philosophy. Okay. Live it, love it, learn it. Okay. Secret sauce, baby. Secret sauce. All right. The ETF portfolio, this has been just a wonderful, wonderful way of exposing some passive dollars, 37,613 to these 11 sectors in the S&P 500. Obviously, we had a roll off today. No problem. This can take a dent. This can take a lot of shots and still continue to fight on. And if this does end up incurring some downtrend, you'll notice that the dollar amount here is something that I'm comfortable with. For example, if I looked at this, it's bulletproof. Am I willing to take this account into a half-life? Am I willing to lose 50% of this portfolio and still be able to sleep at night? 100%. Am I willing to take this into a downturn of 50%? and then willing to step in being down 50% and double up the portfolio at that time, strategically looking at that as an inject point in the market? Absolutely. Now, do I think that that's going to happen? No, I do not. Okay. In all my education and all my assessment and instinct about stock market investing, these ETFs over time usually will turn back about 10% per sector, no matter what. Okay. Technology's been on fire the last 3, 4 years. I get it. Technology rolled off hard today. I'd like to see some other sectors step in and get some participation in this market. Okay. Now, this part of the show is going to be pretty awesome. Okay. I'm rolling out the top 25 of the portfolio, the dividend portfolio. The dividend portfolio is housed with 50 stocks. Okay. These ticker symbols are the top 25. And for you guys that are frantically running and finding your pins so you can jot down these so you can invest like the I2, I give you this information free of charge. Okay. I'm going to let it play a couple of times. This is 25 holdings. But if we go through this, you'll understand that the top 25 houses just over 50 grand, 52,192. Top holding, Lockheed Martin, Cisco, McDonald's, Bristol Myers, Sanofi, Johnson & Johnson, Chevron, Verizon, Enbridge Energy Transfers, Home Depot, British BTI, British Petroleum, Pfizer, Comcast, Duke, Procter & Gamble, Altria Group, CBS. I almost got them all. I ran out. Sorry. We got to get them on the next roll. But you guys can understand, and I don't share this as I used to share them through M1 Finance. I really enjoyed it, but man alive, am I really enjoying the high dividend yields on idle cash with Fidelity? And this is just an awesome way of doing it. So Pfizer, Comcast, Duke, Procter, Altria Group, CVS Pharmacy, Canadian Mutual, Pepsi, Total Energy, TAP, which is Molson Coors, Kimberly-Clark, HSBC, and NextEra Energy. That's 25 stocks right there. $52,000 comprised in the top 25 holdings of the dividend portfolio. That's 25 holdings out of 50. Okay. This dividend portfolio in its totality, all right, will render 4% of yield per year, which is about $3,200. Okay. So pretty cool. This is a kind of a cool way to display it. I'll let it play a couple of times. You guys can play this back and see what I'm working with. You guys can scrutinize. You can come on and say I'm an idiot. No problem. You're entitled to your independent opinion just the way that I have. All right. But I've looked at this up, down. I've looked at ratings on every single one of these companies. I've looked at the dividend yield, and I've really tried to base this holding core of 50 stocks to give me the most renderings in a good suite and basket of dividend stocks. I know Warren Buffett would say I'm an idiot because I diversify. I just believe, number one, I don't get the deals that Warren Buffett does. Number two, I don't have the wealth that Warren Buffett does. And number three, I love this idea, and I do believe that there's a lot of sound businesses out there that I want to have a certain amount of allocation to and participation in. And that's what this is. You can call it diversification. You can call it whatever the hell you want, but this is what makes sense to me. All right. And these top 25 really do kind of speak to my insistence on that. Now, these are the bottom 25 holdings. All right. So you're getting a 50 stock whack. And I'm just going to let you guys look at this for a second while I enjoy my rum and Coke. Cool stuff, huh? Yeah, it's fun. I told you it could be fun. Investing's fun. You should have fun. I have fun doing the Independent Investor channel. I can't believe we only have 27 people in here right now. I would expect that we have, I don't know, 27,000 people in here, but hey, I guess people have a lot more important things to do than figure out how to actually accumulate, grow, and really structurally build wealth with their time. I kind of feel like it's 60 minutes well worth mine and your time. This is real. This is what's going down. And this is how we've comprised the portfolio. A lot of work went into this week. A lot of research, a lot of new positions, some liquidations, some shifting of positions into the Roth IRA, and this is how we fared where I felt like these holdings each were the most appropriate to be held in this dividend portfolio. Now, just because they're the bottom 25 doesn't mean that they're the bottom 25 worst companies. That doesn't mean that at all. Okay. It just means that dollar wise, the highest portfolio dollar, the percentage of allocation went to Lockheed Martin, and then all the way down to the lowest holding. Okay. I was also looking for some really good yield and really good upside. So Suncor, Valero, Southern Company, Morgan Stanley, Bank of Nova Scotia, General Dynamics, RY is Canadian Bank. It's Royalty, RY. Yeah. Canadian Royalty. Okay. And I'll share the rest of these as we come through. So the yield, or excuse me, the total value, just over 25,000 in these bottom holdings here: Citigroup, Shell, Gilead, ExxonMobil, Kraft Heinz, AbbVie. ACI is Albertsons, number one grocer in the world, in the United States. Mondelez, Medtronic, Merck, Oran, French Telecom, MetLife, Coca-Cola, USB, IMO, RTX, TD, and then Hewlett Packard as the newer position in there. Just a smaller position in that. So kind of a cool way to cover the dividends. What I'll do is I'll probably just continue to talk on the live stream, and that way I can kind of show you guys. I don't expect that these holdings are going to change much going forward. I have built this to take into somewhat of a downtrend. I don't expect that the dividend yield there that you see, the 4% or the $3,100 a year that this portfolio is going to render, is going to be affected very much if we have some volatility kick up. Is obviously built around the value perspective in this portfolio. So I'm glad to have been able to construct this the way that I have, and to be able to convey it to you guys. What it means for you guys: don't try to build this overnight. If you're a multimillionaire and you're coming to the I2, you have the funding. You could do this. You could build it. I'll send you a bill, because this is years and years of expertise and understanding of what the hell to look for and how to build it. And hell, if you want the dollar amounts, I can send you that. I probably will send you a bill, because this live stream, it doesn't cost you anything to come in. You don't even have to sit through commercials on my live stream. So you're lucky to have me convey this information to you, because this is right out of my own playbook. There is a small thread of trust that must be rendered through the I2. But if for some reason you sit across from me and deem me untrustworthy, then that's your prerogative. I can just tell you that this is what it is, and these are the dollar amounts that are rendered. About 77,000 in total in the dividend portfolio, allocated as such from holding number 1 all the way down to holding number 50. Okay, very good. And here's the new bucket. This is what we were talking about. Palantir, I have chosen to take the very, very small positions. These are a couple of shares. Okay, $8,400 does not go very far when you're looking at entering into, I think it's 11 companies. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 companies. Okay, so a couple shares each. I think 6 shares of Palantir, a couple of Apple, a couple of Meta, Amazon, and so on down the line. Okay, I even think some of these I only have in 1 share, because I'm starting the portfolio, so I'm building it. But I wanted to have the bucket that was specifically allocated to growth. So if I have a company like Palo Alto Network that I don't have a place for, it's going to go in the growth. If I want to invest in Booking Holdings, which is a fantastic company that just blew out the numbers, top and bottom line, people are traveling, then I can house those assets in this a little bit more appropriate. You can see I've got my favorite fast casual Chipotle Mexican Grill here. there's some other YouTubers that are featured channels of mine that talk about some other really good restaurant chains. Texas Roadhouse. I know Joe Carlson is big on Texas Roadhouse. So Darden restaurants, whatever floats your boat, there can kind of go into this. And I know there's some argument that can be had with regard to Apple being more of a value play than a growth. For me, it's really about the technology hook and about coupling those really good transitioning from growth to value, and a company like Palantir that's trading at 600 times forward earnings. Okay, so it's a good mix. And you can kind of understand the methodology as to why I did this. And I control that risk and beta that I spoke about at the top of the live stream with the anemic allocation here, $8,400, just not even a $10,000 bill in this portfolio. It's a starting amount. We're going to start and build from here. That's what we do. We're builders. That's what we do. All right. Very good stuff. That's the growth portfolio. TSP. I got a little kerfluffle going on with this going on right now. I don't know. I've got a lot of this put to the side. Okay. To be real, just a quick story on the TSP. 2011, the Roth TSP comes online for me. I look at it, say, yeah, it's a good deal. I want to do it. And I thought, you know what? I'll just start this, and at the time I started it, I did 2%. I thought, you know what? By the time I retire, I'll have 100 grand in this account. It'll be a slush fund, easy, additional, right? Over and above the blah, blah, blah. Fast forward now, 14 years removed of that, and look at where we're at. And haven't even met my 20-year mark with my career, and do plan to do 10 more years. I guess the question is, where is this going to be in 10 more years? Is it going to be just a fun money account or whatever? But the takeaway for you guys to understand is the perspective on the onset when there's nothing in the account to say, if I do 2%, how much could this grow? Now, just full disclosure, I do 25% of my pay now, and have done that for the last couple of years, if not 3 or 4 years, because the surplus capital grows as you grow with your career, and the earnings grow, etc. I don't take and I don't spend that. I take it and I allocate that to my TSP. I'm almost maxed funded on this. Not quite. I think this kind of shakes out at around 21,000 per year. I think I can do 24.5, something like that, 24. I don't even know. Right. But I do end up allocating this, and I do end up falling a little bit short of the max funding in the TSP, but kind of a cool lesson there for people who are thinking about participating in a 401k or something of the like. It's really hard to have that perspective on the onset, but it really demands validation when you look at an account that's grown that you didn't think was even going to reach 6 figures by the time you retired. So here's the corporate account. I just share that for visibility. The savings has went down. We treated ourselves this week. We treated ourselves. We are savers, not spenders. But we did make a pretty awesome purchase for us. And you're just going to have to follow me on social media to find out what that purchase was. Okay. So we absorbed a little bit of that purchase, and we're very blessed to be in the position that we were able to put a down payment on that new purchase. And that's where the reduction in the savings for you guys that follow me and have deliberated through these portfolio reviews. This was, closer to 50,000. 10,000 went to the dividend portfolio. 7,000 went to fund one of the Roths for this year, and the remaining little bit of cash went toward a down payment on a new 20-year anniversary gift for my wife, and that's the way that went. Very happy. Really, I'm kind of pinching myself because to be able to have those means, I don't come from means. I was given nothing. I was given love. I was, well cared for. But we didn't have a whole lot growing up, and to be able to engage in some of those expenditures is very much appreciated by me in this phase of my life at 47 years old. And to be able to do some of those things. I'm very, very blessed. Here's the 401k. This is the only matching bucket that we have. Just over 11,000 here. Okay. With a total portfolio value 767, 643. So you guys notice that we were over 800 last time, still over the 750,000 mark at a total portfolio value. Did take a little bit of hit. What I don't convey in this portfolio value, which some of you guys have expressed an interest in, and I do have an interest in sharing, probably have to take me ripping over to Rumble and starting my own Rumble channel on some of my alternative assets, because what's not conveyed through the I2, we speak about stocks and savings and investment checkings, blah, 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 right? All the cool stuff about investing. There are other pockets of value that I do put a lot of credence in a lot of a different light than I do stock investing. Okay. I really value my, my dividend portfolio. I really value my ETF portfolio, but to an extent, it's a shallow validation of those assets. Whereas my baseball card collection is something tangible. My graded card collection, and I'm very, very specific about high grade PSA, collectible items that I feel like are absolutely investment grade. I'm always tried to achieve those PSA 10s, which is the highest grade, which is basically a perfect rendition of those specific cards that I would seek out when I was younger. That is one of those alternative asset categories, and then one that I don't like to speak about too loudly on YouTube because they do frown upon it. Rumble is much more open to discussing the fact that firearms have been around for the last umpteen million decades, centuries. Um, and I just so happen to have a nice alternative collection in that category as well. No rare art, very little precious metal, which I do, they have their places as well. But I think I mentioned that because for the audience that are catching the live stream, you can really get a sense of my my builder's mentality. Um, and more specifically, I think a collector's mentality is more specific. Am I collecting stock? Yeah. Yeah. Am I always trying to fortify and build that up? Yeah. Am I trying to acquire more assets, right, as it pertains to those alternative categories? Yes, I am. And for you guys, I'll share this. And I love sharing these types of things with you guys because I think there are people out there that can relate to this. I think there are people out there that, when I was a young boy and I was collecting cards, I collected cards during the junk wax era. And, most of that stuff at the time, you were like, okay, well, there's so much of it produced. It's not worth any money. If you don't have a Mickey Mantle or a Babe Ruth or a Honus Wagner, you're nothing. Well, come to find out now, I'm looking back at some of the Roger Clemens and Wade Boggs and Tony Gwynn. And if you can get some of those cats, Nolan Ryan, I mean, I can go on, Ricky Anderson, I can go on and on about some of those categories. And it really helps me fit a niche and kind of scratch that insistence of, fulfilling some of those things that I couldn't have as a young kid because, you did need those dollars to invest and seek out that King Griffey Jr. rookie card or, whatever it is were some of those things. But I had it at a young age. And you think, well, how does that lend itself now to the activity that kind of helps me? Like, I used to play blackjack in my 20s, and I don't do that anymore. It doesn't make any sense to me because what fills that for me is the investing game. And that's what I want to convey on the Independent Investor channel is the ability to really talk about those things. And that's the beauty of life. I don't do it because I'm forced to do it. I do it because not only do I love doing it, I really do have an affinity for it and I have a passion for it. I wish people had more of an affinity for it. I understand that there's a lot of people out there that I think are probably a lot more willing to shy away from the financial topic. Me, not so much. I put it right there in your face. For me, it makes more sense to talk about it I think it's a little bit more cutting edge. I know some societies and some cultures really find that faux pas to talk about personal wealth, and I do talk about it mostly in general. I cut a little bit deep for people so I can convey to people that the philosophies that I speak about are ones that I don't think are necessarily unique to me, nor do they need to be, but can be conveyed to a grander audience and also appeal to a grand audience. So I have to put myself in the listener's seat and think, what is it that I could look at from Ryan's message week to week and say, man alive, pretty cool stuff. I learned a lot. There was a lot that he said that I maybe didn't understand, or maybe he, admitted to be investing a long time and he's got a portfolio that I need a couple years to get to, right? But hopefully, if you got the right message, you truly do understand that you can get there. I've had my pitfalls, I've had my perils, I've had my roadblocks along the roadmap of the investing game, and I can tell you that every live stream that I convey is the attempt at sharpening the spear just a little bit more, evolving just a little bit more, and you guys are the recipients of that. I mean, if I had all the answers, hell, I would just convey it, but I don't believe that anybody does. I believe that this is one of those games that it will humble you. I've been humbled. I don't mean to scare you when I tell you that stock markets go down, but I'd be lying to you if I came on and tried to convey that because the momentum and hype is going toward the market going up every single year, and that earnings are going to somehow just continue. I mean, I have not seen an analyst come on and be like, can I just take a time out right now and remind people that we are way exhausted to the upside? I would love, and I watch CNBC, and they all come on and they all say the same thing. The bears that I know, it's like they don't invite them on until we start to get this little ripple of crack in the market. And then you'll find that all the panels are bear. And they're like, yeah, we were overrun for 2 years. And, we were completely overstrung. And we've got a $36 trillion debt. We've got a real estate market, houses that they're all out of whack. And, they'll start to uncover all those things that we can uncover now for our own benefit, and understanding kind of where we are right now in the cycle. Okay. Very cool stuff. I got Kat in the house, man. She's been with me a long time. Appreciate you coming on, and thanks for being such a loyal member of this community. The very least I could do is give you a ninth inning shout out on the fastest 60 minutes on YouTube, getting a 52-minute shout out. But you were the first one on the live stream, Kathy. I really appreciate you and your support. Very cool stuff. Very, very encouraging to me. I have a lot of really, really good people in the group. Yeah, it's the lifeblood of the channel. There's no doubt about it. I'm very, very thankful. Hello, Ryan. Thoughts on Charbonne? Charbone's an interesting play. It really is. Initially when I looked at the business plan, their plan is really good. I just am not sure how unique it is outside of them taking on the electrolyzers, which are, what's to preclude a company from just buying the electrolyzer themselves and making the clean hydrogen? Now, what makes clean hydrogen clean, right? It's the energy source that goes in to power the electrolyzer, right? So it's really kind of is gray hydrogen really that bad? You know, if we're using grid power, we're producing hydrogen on the back end. The only thing that makes it green is the input energy that's going into comes from, thermal, hydro, solar, right? So it's a circular input of the power that's powering the electrolyzer, therefore to be considered green hydrogen and therefore demand a premium, right? There was an interesting interview that I saw as of late that really kind of introduced way too big of a crack of bearish thesis for me, which I hadn't been invested in the company for quite some time. Which really and the executive, I can't remember his name. I will. I'll say Charette is the executive with Charbonne. I think their idea is really good to take the hydrogen into strategic locations where they have that source of green power, right? To power the electrolyzer to make the green hydrogen and then ship it strategically locally, right? That's their business plan. What I got kind of caught up on is the phases of implementation and the necessary permitting necessary in some of those phases. Admittedly, some of those projects may never get past phase one, the phase two, phase three, and they're talking about phase 4 and 5 in a lot of projects, an area of which they have even one project stood up. And I do believe Sorrel Tracy will come on the line. I do believe that the Detroit project will come online, and I think shareholders could be really rewarded. It's just what I would caution investors to look at is the business plan. And I'm independent with my application. I could be dead wrong on this, but when I do a deep dive and analysis, I have the ability to look at a company, and when something catches me that doesn't fit right, either on the positive or the negative side, I have to analyze that and come to a consensus for myself. Okay. And you'll notice I haven't covered the company for a while. I wish them all the best. Like I said, I think that the framework of the business is sound. It's just that, when you look at the capability and the availability of electrolyzers, again, what's to keep some of these, chemical companies from just ordering their own electrolyzers and producing green hydrogen, not green hydrogen, but gray hydrogen, right? The green portion of it demands that premium, and that's the politically driven, like, hey, we sell green hydrogen because it's circular and everything is economic, environmentally sound, right? Businesses don't need to care about that. All they need to care about is producing the hydrogen that they need in their production, right? So, yeah, I appreciate you bringing it up on the live stream. That's about the best consensus that I can give you about what I saw, and it was really, really apparent to me after that last. I think it's David Charette interview that I caught. Mariusz interviewed him, asked some really probing questions, phenomenal questions, almost too good of questions, enough to where the questions were so good that the answers kind of failed to meet muster with me. Okay. Very good stuff. And great to see you. Thank you. Thank you. Not the last with Charbonne there, splitting water, not natural gas or methane. Big difference there, in my opinion. Yep, that's exactly true. That goes with that green, and that's what drives that premium as well. Um, how far can they get with the local municipalities to pull the permits that they need to be able to pull these projects off? Furthermore, are they going to be able to take on the debt financing to be able to start these projects in the strategic locations that they're proposing? If they can get that in the first couple of locations, then they'll have a template to work forward. And if that happens, and Charbonne can show that they have got a business plan that is duplicatable, shareholders could benefit from that project. For me personally, I'm not invested in it right now. My conviction lies in plastic recycling, and that's where I'm at with my conviction growth play. But all the best of luck to you. Very good stuff. Please get on the phone with Drunken Miller about Aduro. Drunken Miller. That's kind of what I thought. It was like that scene in Blow, where Johnny Depp's sitting below the guy and he tells Johnny Depp that he had the wrong dream. That's kind of what I thought of. Like if we had a strategic inject like that, I don't think Stanley's picking up. I think he picked up what was 1.6 million, is it 16.9 million to be exact. Everybody's calling it $20 million buy, but I looked at the F-13. So let's just call it 20 million, 1.6 shares. I don't think Stanley's getting a hold of 1.6 million shares of Aduro on the open market. I don't think it's possible. I'd love to see a strategic inject. I'd love to see that happen, but yeah, Pure Cycle is another one of those that I've looked at it up, down, and I'm not going to profess that I'm an expert in pure cycle. Not going to do it. But what I have looked at, it's just a simple of this, and I could talk for hours on pure cycle. I would just say this. It seems as if they're building a plant to have plastic shipped into them. Adura's business plan is such that they are looking to modularly be able to take the solution to their clients. That's what it looks like to me. And I think that is a huge, huge strategic advantage to be able to flex to what the customer needs. Pure Cycle is basically saying, this is what the customer needs. We're going to build this multi-million dollar plant, tens of millions of dollars dumped into this project. And I find, and I've seen this error in a lot of businesses that I've covered, in that they almost try to produce a market. We know that there's a market, and an addressable one at that, excuse me, for plastic recycling. But this just seems like an offshoot of trying to create a sub-market of, there's so much plastic being produced that somehow there is going to be collection method enough to bring it to a central location. And I just don't see that happening. And I think that's the fallacy of pure cycle. And I think that's one of those things that I don't see being talked about very often. I wish the guy all the best. I really do. I think if I were looking at it and I didn't understand shit about the plastic recycling, I would invest in pure cycle as well. But in my particular opinion, I think he had the wrong dream. Okay. Yeah, that's my 2 cents. We will see. We will see. Very good stuff. Cruise to the top here. Got Reginald is in the house. Very good, Reginald. Shout out from the I2, baby. Good to see you, man. And the Victor's in the house. Good evening, fellow investors. Hope all is well. It's the community that we like to promote. Very good stuff. Kathy, I've changed from working in finance-related job to legal assistance. Very good, as that is the only job I got in the new city I moved to. I have way more money in my early 30s than a lawyer who makes 200,000. Yeah, and you know the cool thing about that is, and I want to thank you for sharing, number one. Number two, it's kind of a relative program that I speak about. I know lots of multimillionaires. It doesn't really, I don't really look at people as the measure of how much money they have or not. It's just, with more money comes more responsibility. How about that for a charge? I think it's great if we're getting paid for the fruits of our labor. In other words, knocking down a couple $100,000 a year job. That's great. We just have a responsibility to filter it, as I speak about on the channel, to the buckets that I speak about, right? I mean, you could go back and play that dividend portfolio. If you invested that way, you'd be investing lockstep with somebody with going on 30 years of experience in the market, and to the tune of a portfolio that you can handle. I mean, 77,000 for a small fry like me, that's what I've got in that bucket. But you'd have the dividend growth portfolio covered. If I miss something there, please let me know. But passive's easy. I mean, the 11 sectors of the S&P 500, very, very simple to understand what percentage of allocation of technology to the S&P renders, right? And then just equate that dollar amount to that specific ETF holding, i.e., technology, financials. You don't want to have the lion's share in utilities, which is an underrepresentative sector, an important one at that. But there's just not that many holdings in that specific sector representing utilities, right? So the money and the renderings have to be somewhat on par with those if you're going to strategically break up the sectors and have something that holds all the sectors. But I give that away. I do. I mean, 11 sectors, anybody can take that philosophy and have the passive bucket taken care of. You can do the Roth if eligible. It sounds like you're making good money there, so the eligibility piece comes in. But if you are still, or you've built it when you made less than the cap, but the last I checked was 130,000 as single, 250 as married. It could have moved off of those figures, but the idea behind that is that you've housed those tax-free monies in that Roth. Those don't have to go anywhere. You may be ineligible to contribute, but you've built up to this point, and now you have these different buckets, and you say, my goodness, Ryan does his business with Fidelity, and Fidelity's paying 4% right now on idle cash. That's insane. So I mean, you could build up 40, 50, 100 grand. That type of income, maybe 100 grand of white meat is prudent for you to have in a savings account. Making 4% off of that money, that's free money, free of charge, right? And then the growth perspective as well. If you're making that discretionary income, you can have that growth bucket in the capacity that I spoke about. And then you kind of have all of those bases covered with the Roth IRA right on top, with the passive, ETFs, maybe throw some international exposure in there, some dividend ETFs or some, S&P 500 covering. You kind of got it all, right? So, and you got it all independently. Like, you didn't seek out a financial planner, didn't sit down with you, and they're going to talk differently to you. They're going to show you a basket of 6 mutual funds, right? Because they get paid on every one of them. Me, I don't care. You can send me a bill, if send me money if you want to, but this is free. I'm giving it to you. This is what I do, right? I used to sit down with those financial planners. I had one with Smith Barney. I've had 3 with Edward Jones. I had one with Thrivent Financial many, many moons ago, right? 4, 5, 6 total. I've been there. All right. Me sitting down with them right now is 2 completely different philosophies. Neither one better than the other, in my opinion now. Okay. Everybody's got to select their own method. And a lot of people will come into the I2 and they'll be scared off by it. They really will. They'll say, God, I don't know. I just can't do this on my own. I just feel like people conquer way more difficult things in their life, and they do so, and they look at finances and they think, I can't figure it out, and they throw in the towel after 5, maybe 7 minutes. And finances, as important as it is, if you're hyper focused on it like I am, and it becomes kind of a way of life for you, and it becomes kind of a passion, it really can render benefits. But you can't expect to get involved in something that you've studied for all of 7 minutes and expect to render better than average results, right? Where we'll study for a test in college for many, many hours, or we'll write that thesis for many, many hours. It's like, you got to understand that it takes that time to study. That's where the I2 comes in to kind of help break some of that stuff down, so people aren't left alone trying to do it on their own, right? Even though the very niche of my channel is to insist that at some point we would like to get people on their own, in some basic application in their financial prowess. But thank you so much for coming in. We save, we invest, about our house. That's right. You've shared that. I remember. Didn't you put money in the RRSP? Yep, that's Canadian. And we cook. We do the same. Those are habits of successful people. And to be honest with you, these are habits that are pretty cool. When my subscriber community, they come in and they share these things, it's pretty awesome to validate. Number 6, listen to Ryan Marius. Sure, some of the people in my small circles, with the amount of reach that I've been given on the I2, with the small subscriber base that I have, I'm thankful. I'm very blessed with the people that come in, and they they frequent the channel, and hopefully it's benefiting on the bottom line. I appreciate you. Phenom's been with me for many, many years. I really appreciate, just an awesome stand-up member of this community, and it's what makes the channel go around. That's for sure. Awesome stuff. Excited for tomorrow. Very good. I'm gonna get to everybody. I'm going a little overtime tonight. I don't really care. I'm feeling it. Had a good deal last night. I got Michael in the house. Pfizer, AT&T, all up. Drug and food sectors up. Yeah, it's just indicative of what I'm seeing. Utilities were up today. I did buy some Duke and Southern Company. I've owned NextEra for quite some time. I would stay away from REITs right now. I'm not a huge fan of real estate right now. Builders, I'd throw everything. It's all going to get thrown out with the bathwater if people start to realize that this 5% hiccup today that was reported on new home sales is very, very real. And I think indicative of and sign of the times for maybe the next coming months and maybe even bleed into the next couple of years. All right. Very cool. Earnings rose a big beat. The best way. Yep. Very cool. Appreciate you sharing. It's going to be revenues. Very good. Insider spot from 7-Eleven. Very good. Michael, thanks for coming on. Thanks for being part of the community. I'm going to have to let me kick over and do it now. I can do this right now. Got a few moments. Here we go. There you are. There you are. All right, Michael. Now you've been anointed. I just threw a wrench at you. Very good stuff. Very awesome, man. This just so happened to be the fastest 70 minutes on YouTube. But you guys get the point. I really, really appreciate your followership. Very cool stuff. We'll end on an aloha. Dave, this is like extra innings for you, brother. Sorry for the 10th or 11th inning call out here, man. But, you know, you can get a hold of me anytime, man. Hey, he says American Samoa. He's not joking. This guy is an international man of mystery and just one hella cool guy, man, and one that I consider a friend. Like I said, I kind of touched on it tonight. A lot of cool people in the community, and Dave just represents that. And I want to thank everybody for your time. Stay tough. We'll go into next week. Today was a pretty crappy day in the market. But I do want you to keep a perspective about this. We want to build the portfolio to weather both ups and down markets. It's very, very important for investors to understand that this is a double-edged sword when we're talking about stock market application, and where it's fun to come on and celebrate when markets are up. I typically to find a lot more value below the surface in talking about when markets aren't so nice. So I appreciate you guys. Have a great rest of the weekend, and we will catch you next week.